Hey, welcome back to the Consulting Mind. Today we're going to continue with the All You Need to Know About series. And today's theme is the potential negative interest rate in US. As you might have been aware of, recently there is a heated debate among the market on whether or not and whether can the US impose the negative interest rate. And there are lists of arguments of why and why not the US should do that, and we are going to explore that. And this episode is aiming to give you a framework, provide you with a framework for you to understand the overall argument and the impact of the pros and cons of doing the negative interest rate. And more importantly, I'm going to illustrate with you the impact on the market with the negative interest rate in particular, which asset classes might or might not be benefit from this implementation. So let's begin with the definition part. When we talk about interest rate, we refer that to the Federal Reserve Fed Fund rate, which is the very foundation interest rate, and it affects all the other interest rate in the market. This is one of the monetary tools adopted by the US Federal Reserve in order to guide the commercial bank and lender on the interest rate, and also to control and influence the overall money and credit supply available in the market. And when will they raise the interest rate? When they see an heated economy, when the economy is booming and they are worried about the potential inflation, the Federal Reserve will raise the interest rate in order to increase the borrowing cost, in order to reduce the money and overall credit supply available in the monetary system. And on the contrary, when they see a potential recession or when they are seeing the lowering of the economic activity, just like now, they will do the rate cut in order to decrease the borrowing cost, to stimulate the borrowing incentive from the market, including for those consumption, for investment, or for other purpose. So, what are the reasons for supporting implementing the negative interest rate in US? The first one will be it helps credit creation. Just like the experience in Europe zone and Japan. When the interest rate is lower down to a negative level, it will help reduce the borrowing costs and the lending costs, not only within the financial sector, but also the overall economy. And as a result, the demand and the consumption needs and the investment needs will be boosted up, and therefore benefiting the whole economy. And the second argument will be search for yield. What does that mean? When the benchmark interest rate, i.e. the Fed fund rate, is lower down to a negative level, it will force the people to search an alternative, to search for higher yield. And as a result, people will start looking beyond the money market, from money market to the bond market, and it will help boost up the high quality corporate bond and mortgage bond. And the third reason, which is also the one which are most commonly upheld by Donald Trump, is that it will help weakening the US dollar and as a result strengthening the competitiveness of the US export. And what are the opposite arguments? The first one will be it will put more pressure on the lender margin, in particular the banking sector profit margin. And you may wonder why. Because intuitively, as there is negative interest rate, the bank can actually transfer the cost to the customer. It means that the bank can actually charge some fee based on the deposit, which should be beneficial to the bank profit. But in reality, especially in the initial phase, it is very hard for the bank to transfer the cost to the customer because the customer or the depositor might instead choose to use the physical cash or even withdraw the cash from the bank due to the fee to be charged by the bank. And the second argument for not doing the negative interest rate in US will be it might probably drive the investor out of the money market. The US money market is a very huge market involving about 4 to 5 trillion US dollar. And as a cornerstone of the Wall Street infrastructure, financial infrastructure, The money market mutual fund will usually buy very short-term debt from those highly rated bonds from bank, different companies, government, or even municipal sector, and providing them with a key source of cash. And yet, the negative interest rate will erode the yield earned in such fund, and therefore it might drive those investment out of the money market, which will be a substantial damage to this sector. And the third argument will be it will also be negative to pension fund and insurer, because nowadays in the low interest rate environment, those pension fund and insurer had already facing a very large difficulty in finding those good quality bond to invest, because the yield is just very low, and their asset and liability side is just very hard to be matched at current status. And the last argument will be external finance. As you might have aware that U.S. is a country that is heavily relies on external finance. And what does that mean? It means that every year U.S. government face a deficit, and the deficit has to be funded by issuing a large amount of U.S. Treasury. And foreign investor is a significant player, significant portion of the funding source. Therefore, when the interest rate is reduced, the attractiveness of the U.S. Treasury or the U.S. government bond will be affected, and therefore the investment demand from the U.S. government bond will also be reduced, which is not good for the external finance of the U.S. current model. So finally, let's do a very short summary on the impact of the negative interest rate on different asset classes. First one, money market. It should be negative because the yield will be eroded and the investment will likely be driven away from this market to other sector like the corporate bond. The second asset class, USD, again, it would be also negative because interest rate is a very important consideration when doing the foreign exchange transaction. Third asset class, equity. The impact on equity is kind of mixed. On the positive side, the traditional theory and the rule of thumb will be that when the interest rate is going down, the equity will go up, which is a negative correlation. But on the other hand, there is also some uncertainty because we are still not yet certain about what will the negative interest rate do on the real economy, and in turns, what will the impact to the equity market sector in the long run. And the fourth asset class, bond. As mentioned before, bond and interest rate again is negative related. When interest rate go down, the bond price supposedly will be go up. But again, the impact on different grade of the bond, like high quality bond, the investment grade bond, or even the junk bond, will be different. And the final asset class will be gold. The impact on gold should be positive because the interest rate of the underlying currency is actually the opportunity cost for holding the gold. What does that mean? As you might already be aware that when we are holding gold, it cannot yield any interest. Today you buy $1 gold and the next year the price will be the same. But when you use the fund to invest in the US deposit market, there are interest earned. So the negative interest rate will actually reduce the opportunity cost for holding gold. Therefore, it should be positive to gold. I'm going to sign off here. Hope you like the video. If you like the video, please click the like button for me and subscribe to the channel. Thank you.